To what degree does seasonality play in the direction of markets? Here we are now, just about to close out the first month of 2023, and it's been an interesting direction of travel. And of course, we just come back from the Chinese Lunar New Year. Let's take a look now at all this and put it all together and work out what it means for the rest of the year with Ron Williams from RW Advisory. Ron, welcome.
Hi there.
We've recently spoken to you about the China reawakening, which is an interesting story in itself. But I wanted to get you back in to talk about your research on this idea of seasonality and how it affects us traders and how we perceive the year might go from this early part of the 12-month period.
Well, it's a great time to be doing it on the day of the end of the month of January. And in ancient times, it was the Roman god Janus that could see both the past and the future by extrapolating one to the other. And that's basically what we do in market seasonality analysis as part of timing. And so back in the 70s, the stock market almanac actually developed what was called the January barometer, which is one of a variation of New Year seasonality measures. The barometer is basically extrapolating the performance of the month of the new year, with the thinking that as the year starts, so will the year likely perform. And so our opening chart illustrates how this can work sometimes, but of course, as with all things, not every time. And here we see data analysis from Fidelity, but this can be done at the trading desk, just showing the years of 2020, 2021, and 2022, so the years that everyone remembers right now, where it worked in up markets and down markets. But what's interesting is if you go back to 2020, that is the year, of course, that we try to not remember, the year of the health crisis and the pandemic, where the market cliff dropped before it then rose to new highs. So there was a V-shape pattern. And yet, you could see the January barometer did work, 3% up at the start, then 12% to end. 2021 was the typical trend following dream, where it was just more of the same, linear move up, 2% at the start, 28% at the end. 2022, it flipped exactly the other way because the party went on for too long. Markets were overvalued and overbought. And in the end, January, if anyone recalls, and we spoke about this actually at the time, it was the worst performing January since the 2008 global financial crisis. So it was a real warning shot. Things have changed, reevaluate, and of course the rest is history. Looking back at the year that passed, it was one of the worst performing ones on record, and many traditional strategies stopped working, like the 60-40 portfolio and much more. So certainly things had shifted, and this seasonality pattern still rang true.
Okay, so we got data in the past. What signals do you gather together? What indicators do you like to use in order to give you an indication as to how things could develop?
A blend of quantitative and qualitative. Of course, we tend to focus more on one versus the other. I think the data-driven stuff is probably more popular over the last few years, especially with computing power and whatnot. So it is good to use that, harness it. But as a traditional chartist, I still like to look at the chart and apply some context. So we begin with that in terms of the big picture on the left. And this is showing 20 years performance of the January barometer. And instead of cherry picking the best examples, I'm giving you the best and the worst, when it works and when it doesn't. But the key message here is not how reliable is this signal, and it's a signal, not a trigger. That requires risk-reward analysis, technical analysis, and any other due diligence. But what this shows here is chart context. Trend matters. So if trend is up, expect more of the same. Trend is down, same. And so what you see is exactly that. The linear extrapolation generally works more often than not. There are some surprises where the market signal flips, but they're rare. And on the right-hand side, you can see the statistical representation, just showing a quadrant of all of these signals, and you can see where there is most sample data is in the top right-hand side, positive Jan up for the year. That's because trends happen more often than not, particularly over history. And so positive years have led to, positive Jans have led to positive years. That's also true for negative Jans leading to negative years, which is what happened last year. And then in the top left-hand corner and bottom right-hand corner is where we get the surprise in the opposite direction. Where do I think things could fall this year? It's in that negative surprise. So we start positive this year, which is what we're seeing right now, and a potential negative surprise. Right or wrong, it's always good to prepare for the least expected outcome, just in case. So at least that way we can take appropriate decisions if necessary.
Okay, let's step back from the academic charts that we look at, and if I can dial in a chart of the S&P 500, which we've got from the record highs of that top that we've got there, and then you've put on here a 200 and a 50 period moving average. The 200 is in red, and we've got this falling line of resistance, which has now become, interestingly, support.
Yes, absolutely. So to keep it real time and objective, and of course to make sure that we're not projecting bias either way, which is easy to do when we have a view, it's important to highlight the fact that real time markets are still rallying up. They have broken above the almighty falling 200-day moving average, which, important point here, the market has failed to hold above, I think, on at least 7 consecutive times over the last year. So since we made the top in late 2021, and of course with that big alarm bell price action of January 2022, it's been straight down as part of this top pattern and bearish trend. And that 200-day has been a nice line in the sand, highlighting that downtrend, but also the failures to push above that. This time could be different. And that's why we have to keep an open mind to either eventuality. If it does, we need a weekly or monthly close above that 200-day, and I would say more specifically 4,100 on the S&P 500 as a key prior peak level. That's a risk level that everyone should be watching. Otherwise, if the price and time filters fail, this could be another bear market rally signal where we could roll back down lower. The end result will of course decide how we close the month of January and what that suggests as part of the seasonality setup.
And of course, as we're saying here, we are on the last day of January, so we have yet to get that measurement. Let me just go back and rejoin your academic slides and ask the question: has the setup that you're looking at happened before? Is this something you've seen in recent years?
Yes, so we can always look back and find historical rhymes. I'm careful to say rhymes and not repetitions.
Right.
Things do vary. 2008 is global financial crisis in terms of the financial market pattern is the one that I use actively, but there are others. You can look back to the 70s, look back to the 30s, or even some people looking to other analogs in between. But each of those bear cycles that I highlighted are potential variations of the downside risks. Of course, there are upside risks that we can also consider, but looking at the downside, given what happened last year, it's good to risk manage. And so 2008 is figure 2, but before we get there, the first chart is here and now, but here and now before the close of the month, and that month of Jan of this year is literally at the right of the chart in figure 1, just below the 200-day moving average, titled 2023 question mark. Now, what's interesting is if I take a step back and just go through 3 key points: market top, which is how this down wave begins, breakdown and follow through below the 200-day, which is key to any reversal signal, and then most importantly, retest of the from an oversold bounce, bear market rally potential, and a retest of the 200-day line or resistance prior support. Whichever way you look at it, there's a bounce back reaction. Now, in a bear market phase that is structurally down, all of these attempts for a rally fail, and they ultimately lead to a waterfall decline. That's what will likely happen if we continue to reject that 200-day line or the 4,100 level on the S&P 500, and different people can look at different levels on different markets. 2008 is a textbook example of what could happen in terms of the rhyme of the price and time pattern. And you can see the distribution top again, break down and follow through, oversold bounce, retest of the 200-day, and then the decline that we all know followed thereafter. So not a hard and fast this will happen. It's a scenario, a high probability scenario, which I think we should keep in mind. And there are other variations. Looking at the chart inserts on the far right, figure 3 and 4, it just shows more of the same. Figure 3 just shows the overlay and how that often leads to a 3-stage corrective move. We're still in this bear market rally phase. It could be more bullish if the market continues higher, and if not, that 4,100 level will be key. Then look to the downside for potential hedge, short positions, or ways of diversifying.
As I said at the top, we've just had the calendar New Year. We're getting to the end of the first month. We just had the Lunar New Year celebrated in China. China now makes up a massive part of market movements, like it's never done before. How important are these two events that give us the kick into the new year? What do you perceive to be the importance of the Chinese New Year particularly?
It's part of the universal timing method in my mind, and certainly having spent some years in the East, particularly in Hong Kong and mainland China, I learned the significance of the different start of the new year based on the lunar cycle just after the winter solstice. And of course the greeting of Happy New Year is to do with health and prosperity, but also that framework, which actually just started recently, is used in terms of just general thinking about the year ahead for life, but also for markets. And so there is the same method can be applied here as part of seasonality analysis, and that's what I've shown here on the follow-up slide. So
we're now in the year of the rabbit, which is, if you look at the bottom left-hand corner, has seen some stunning returns.
Yes, so if we have an open mind to a new system and way of looking at things, essentially it's a different calendar calculated at a different point in time based on an ancient method. There are other cultures that follow the same thing, but what's key is to understand that each of the years have an archetypal symbol. So animals is part of the Chinese or Eastern system, and so as you can see there at the bottom left-hand side, figure 2, the year of the rabbit, the one that we're in, is the best performing one. Everyone can do this just by backtesting which years perform across time, and you'll see those results. There are variations of these results which have been done by local Eastern universities. I managed to read up and see what different research suggested, but essentially this is the analysis that I did, and it is based on US data just because that offers the most historical sample. This is the results. Now what's important is to add an overlay to this, because it's not just the year that matters. It is the year in the element, which is part of a much larger cycle, a 60-year cycle. So the simple way of thinking about this is in our generation, in our lifetime, we will experience each of these animal archetypes, but in only one element, because it happens every 60 years. So that's a good ripe age for most of us in terms of experiencing it twice in a lifetime. And so last year, if we can kind of learn from the past in order to better apply in the present and the future, was the year of the tiger, but it was the year of the tiger in water. And you can see there on the chart on right, what I do in extra time that I have, do some data analysis, and it shows a heat map of the results of equity market return, US market. And if you look at the third column down, tiger, in the water, and I believe would, in those two elements, again, this only happens every 60 years, go one cycle back. It was 1962, that was the Kennedy, JFK, US former president, market slide. It was around the time of the Cuban Missile Crisis. And what's interesting about that is the market went down 30% but ended positive, so not too dissimilar from what happened last year in terms of market rhyme but also geopolitical tensions. And there are other examples too. The year of the rabbit is generally positive, and that's what the chart in figure 2, bottom left, shows. But in the elements of water and earth, there are negative outliers, and I believe 1939, so just after the Great War and into the Great Depression, 1903, and the small one there that ended positive was the 87 crash. These are all potential good, bad, and ugly scenarios that people can keep in mind, particularly in the East where 2 billion people celebrate this different calendar system. It's worth reprogramming our seasonality just to see what scenarios that plays out.
Let's bring it all together and talk about the risk and where we go from here. What do you perceive as the cycle risk?
Yes, so this is all seasonality, market timing analysis that market professionals apply day to day, and it's a key part of the method that I use at RW Advisory. But I put that in combination with an existing framework, which also has its own cycle method. And so that's based on originally roadmap cycle based on the work of my mentor, Robin Griffiths. Economic cycles that are primarily driven by that, but I've expanded it since with other timing patterns. The end result right now is that chart on the top left, figure 1, just showing the composite cycle, which measures risk sentiment in markets all the way back to 2000 peak levels in the tech boom. It correctly predicted the 2008 crash. Interestingly, back then we thought that was going to be the economic depression of our time, but it didn't happen. And actually, ahead of time, the same timing pattern suggested that we had a much worse season ahead, which is actually the one that we're in right now, from the shock of 2020 pandemic into what is still likely a multi-year consolidation bear market pattern. The good news is things light at the end of the tunnel is likely to appear from 2024 onwards, but expect the worst between now and then, where things are not so clear, and that's why I continue to watch the real-time screens and see how they play out, is the short term to medium term. So for now, things are clearly positive. I think we could switch easily in the second half of this year or year end. The additional cycle analysis in bottom left figure 3, based on the work of Benner and Gann, highlight this year and next year as risk levels. So there's other research that's been done a long time ago, tried and tested, that also confirms what my thoughts are still suggesting. And what's interesting, even if we just switch away from technicals and go to the macroeconomic, this is the year that consensus opinion is expecting the worst, and it's expecting it by record extremes. I think in terms of recessionary concerns based to the Philly Fed data, as far back as it goes, that's the consensus. Perhaps they're thinking the worst because they want central banks to stop hiking rates and across the board, but particularly in the US. They're thinking that might sway them and trigger a pivot of some sort. But either way, that's the expectation. And just my final light-hearted point about all of this analysis: if you're unsure as to how high probability this could be, bear in mind that most consensus views last year did not work, as is often the case with outlier market events. And that's what happened in 2022, 08, Y2K. That the bottom right-hand chart there shows consensus versus reality. So apply due diligence either way, and make sure that you're applying some technical analysis with cycle framework.
You said in that last answer there, or that last point. Let's follow the real-time data. I want to go back, if I can, to this chart of the S&P 500 and expand it out and ask the question, how far back do we have to go to work possibly to get a low? If we are, as you suggest, perhaps possibly maybe building up for a bottoming out at some point in the next 12, 18 months or so. On this chart here, that black line at the bottom at 2184 is the COVID low that we had, which everybody references. I mean, it was a stunning rally that we've seen from there. You can't get straight lines in technical analysis, but look at that, it's pretty much straight line if you look long term. Are you fearful, do you think, possibly maybe, that we could well end up trying to test that in the next 18 months if we do get downside emphasis, as is the possibility, as you've explained?
Yes, as a worst case scenario, it is certainly a part of my playbook, or at least I should say risk assessment. The make or break level that would trigger a higher probability likelihood of exactly the question that you asked is the pre-pandemic peak level, which is around 3450. You've actually already highlighted it there in the circle. That chimes in with October 2022 low. So the pre-pandemic peak resistance proved support then, and that line of polarity, as it sometimes is referred to, is the make or break zone, because it's not a precise level, it's a price zone that the market can either hold above and make the bull case, or break below and then unlock further downside risk. So that's the quick first point to my answer. The follow-up is what history teaches us about market corrections, and that is in both price and time we get bigger moves. So price 30 to 50%. We've only seen 30, or 20 to 30, and I know it's still significant enough to hit our pain thresholds, but big market bears are more substantial. And most importantly, which I think we seem to be experiencing amnesia from, is time. Market bear corrections take time to repair and recover, and if you go back looking at any of the big bears, it's on average 2 to 3 years. The reason why we've probably forgotten for now is because the pandemic V-shaped recovery was so fast. We couldn't have fallen asleep for a short time, woken up again and seen that the things were back at record highs again. So we haven't really experienced a bear as history has taught us time and time again. And I think if we think about the macro risk that we've already experienced and what many talking heads are concerned about, none of that has really gone away. Dalio talks about the debt reset, and many others also do too. That, of course, is a rhino risk in clear sight that we have yet to deal with, and I think that marries up with the technicals and the cycles.
Fascinating. Ron, thanks so much indeed for joining us. Ron William from RW Advisory. In fact, you can pick up with this, in fact, in discussion. We quite often take this on to LinkedIn, so if you wanted to follow up with Ron on that, we'll be publishing the interview in the next couple of days, and you'll be able to discuss with Ron some of the points made in this interview.